You are doing everything right. You have the job. You pay your bills on time. You contribute to the 401k. You don't blow money on stupid things. You are responsible. You are disciplined. You are, by every metric the financial advice industry uses to measure a good adult. A good adult. And yet, you check your bank account on a Sunday night and feel the same quiet dread you felt 5 years ago. The number is different. The dread is identical. You are not behind because you're lazy. You are not struggling because you're reckless. You are stuck because the advice you were given, the responsible, sensible, time-tested advice, was never actually designed to get you out. It was designed to keep you in. The middle-class money trap. 7 levels. All of them built for you. Level 1. The good student. You followed the instructions perfectly, that's the problem. You did everything they told you. You studied hard because hard work leads to good grades. You got good grades because good grades lead to good colleges. You went to a good college because a good college leads to a good job. You got a good job because a good job leads to a good life. That was the sequence. Clean. Logical. Airtight. Nobody mentioned that the sequence costs $180,000 in student loans before it even begins. Nobody mentioned that the good job starts at $52,000 a year in a city where a one-bedroom apartment runs $2,100 a month. Nobody mentioned that by the time you finish being a good student and start being a good employee, the financial system already has a 22-year head start on you. And it spent that time collecting interest. You were taught obedience dressed up as strategy. The A students graduate into the workforce and immediately become the most reliable customers the financial industry has ever seen. Educated enough to understand the products, conditioned enough not to question them, responsible enough to make every payment on time. You are not a success story in progress. You are an ideal client. The system didn't fail you. It worked exactly as designed. You were just never told which side of the design you were on. Level 2. The responsible debtor. They called it an investment. The interest rate was 7%. You have student loans. Of course you have student loans. 45 million Americans have student loans. You are not unique in this. You are, in fact, the target demographic. The person who borrowed money to buy the credential that unlocks the income that services the debt that never quite goes away. Here is the deadpan reality of level 2. You are making monthly payments that feel significant. You are making progress that, on a standard repayment schedule, will be complete in approximately 10 years. Assuming you never miss a payment, never defer, never have a financial emergency, and the interest doesn't quietly eat your principal faster than your payments reduce it. The average student loan borrower pays for 19 years. 19 years of payments on a degree you finished in 4? 19 years of your income routed backward to a past version of yourself who signed papers at 18 without a single class in financial literacy to prepare them for that signature. You are not in debt because you were irresponsible. You are in debt because you were told that this particular debt was different. Noble. An investment in your future. The one debt that was always worth it. That framing was not accidental. An investment that charges you 7% annually while you earn 3% on your savings account is not an investment. It is a product. And you bought it at the age when you were least equipped to evaluate it. Because that's when they sell it. Level 3. The homeowner dream. Congratulations, you now own a mortgage. You bought a house. This is the milestone. The thing that separates the temporary from the established, the renting class from the owning class, the people who are building something from the people who are throwing money away. That's what they told you. What they did not tell you, or told you quietly, in footnotes, in paperwork you signed without reading, is that in month 1 of your 30-year mortgage, roughly 80% of your payment goes to interest. Not equity, not ownership. Interest. A fee paid to the institution that lent you money for the privilege of having borrowed it. You will do this for years before the ratio meaningfully shifts. Your neighbor rents. Every month she writes a check and people feel slightly sorry for her at dinner parties. You own. Every month you write a check of nearly the same amount and people congratulate you. By year 5, you've each paid a comparable amount of money out of pocket. She has mobility. She can move for a better job, a better city, a better life without a 6-month selling process, and a 6% realtor commission. You have equity, some of it, and a furnace that just went out. This is not an argument against homeownership. This is an argument against the mythology that homeownership alone is a financial plan. A house is the largest purchase most Americans will ever make, entered into with the least financial education they will ever have, sold to them with the emotional language of the American dream, so the math never gets too much attention. The math, if you let yourself look at it, is interesting. The mythology, if you let yourself examine it, is a product. Level 4. The 401k comfort. You're saving for the future. The future is grateful. The fees are more grateful. You have a 401k. You contribute 6%, get the employer match, and feel, reasonably, like you are doing the responsible thing. You selected a target date fund during a 12-minute onboarding session 3 years ago and have not thought about it since. It is growing, probably. The market has been doing something. Level 4 is where the comfort becomes the trap. Your target date fund charges an expense ratio, maybe 0.5%, maybe 1%. It sounds microscopic. Over 30 years on a $500,000 portfolio, a 1% annual fee erodes somewhere between $150,000 and $200,000 in potential returns. That is not a rounding error. That is a car. That is a college education. That is years of your financial life, quietly extracted in fractions of a percent, every single year, whether the market goes up or down. You are also contributing $3,600 a year when the IRS allows you to contribute $23,000. The maximum contribution limit exists because someone in Washington decided that was the ceiling on tax-advantaged retirement saving. You are hitting 15% of it. Feeling responsible. Building, technically, something, just at a pace that will deliver you to retirement with a nest egg that financial planners with straight faces describe as a starting point. The rule said, save for retirement. Contribute to your 401k. The rule did not say how much or in what, or how to evaluate fees, or how to actually live on whatever accumulates. The rule gave you a direction. The financial products industry filled in the rest of the details. For a fee, level 5. The upgrade cycle, you earned more. You spent more. The math stayed the same. You got a raise, a real one. Not cost of living, an actual merited you performed well raise. Your income jumped from $72,000 to $91,000, and for approximately 6 weeks you felt the specific lightness of a person whose finances are about to improve. Then the upgrade cycle began. Not dramatically. It never begins dramatically. It begins with the apartment that was fine, suddenly feeling like it no longer reflects who you are, with the car payment that was manageable becoming a car payment on something newer, with the restaurants that were a treat becoming a habit, with the wardrobe, the neighborhood, the gym, the subscriptions, the invisible infrastructure of a life lived at a certain tier. By month 8, you are spending $89,000 of your $91,000 income. The raise happened. Your savings rate did not change. Your financial position did not materially improve. Your lifestyle got better and your bank account got louder, and the gap between what you earn and what you keep stayed exactly, almost surgically, the same. Economists call this lifestyle inflation. The financial advice industry occasionally mentions it. Nobody stops it, because stopping it requires something the advice industry cannot sell you: restraint, intention, the willingness to earn more and visibly live the same. That's not a product. That's a discipline. Disciplines don't have marketing budgets. Level 6. The awareness that changes nothing you know. Knowing is not the same as escaping. Something shifts at level 6. Maybe it's a podcast. Maybe it's a book with a slightly alarming title. Maybe it's a Sunday afternoon where you do the actual math. Total lifetime earnings against actual net worth, and sit very quietly with the result for a while. You understand now the lifestyle inflation, the fee erosion, the mortgage mythology, the student loan arithmetic. You can name every trap in this script. You nod along, you share the content. You have opinions about index funds and you say things like, the gap is what matters, at dinner parties with a knowing tone. And then Monday arrives. Your mortgage payment comes out automatically. Your subscriptions renew without friction. Your peer group makes plans at the expensive restaurant and you go because it's Tuesday and this is just life. The knowledge sits in your head clean and correct, while the money moves in the same patterns it always has. This is the cruelest level. Not because you're failing, but because you're not. You're making micro improvements. You canceled 2 subscriptions. You bumped your 401k contribution by 1%. You feel the momentum of someone who has turned a corner. But the structural forces operating against you, the debt with compound interest, the house with compound interest, the lifestyle with compound inflation, the investments with compound fees, those are not micro. They are massive. And they have been running for years. You are paddling against a current with awareness as your only tool. Awareness is necessary. Awareness alone is not sufficient. Level 7. The exit. The only move they never sold you. Here is what the entire financial advice industry, the mortgage industry, the credit industry, the student loan industry, and the subscription economy have in common. None of them profit from the answer. The answer is boring. The answer has no product attached to it. The answer cannot be packaged, marketed, or sold at a conference. The answer does not have a celebrity endorsement, or a 30-second ad spot, or an influencer affiliate code. The answer is the gap. The distance between what you earn and what you keep. That gap, and only that gap, is the raw material of everything. Not your salary, not your credit score, not your home's appraised value, not the number on your 401k statement, the gap. Widen the gap and you are building. Narrow the gap and you are performing. At level 7, you stop performing. You drive the car that runs, not the car that signals. You live in the house that fits, not the house that impresses. You stop outsourcing your financial decisions to institutions that charge you for the privilege and start making them yourself. Slowly, imperfectly, but intentionally. The isolation of level 7 is real and it is not nothing. Your peer group won't always understand. You will decline the vacation that doesn't make sense. You will drive past the dealership. You will look from the outside like someone who is not fully participating in the life your income entitles you to. And there will be moments, ordinary, social, human moments, where that feels like loss. It is not loss. It is the cost of the only exit that exists. Because here is what they never put in the brochure, never taught in the school, never included in the responsible financial advice you followed for decades. The middle class is not a destination. It is a holding pattern. A beautifully furnished, carefully maintained, socially validated holding pattern. Designed to keep you comfortable enough not to demand more and just busy enough not to notice you're circling. You were never supposed to escape it. That was never part of the plan. But it can be part of yours. You've been doing everything right. The problem was never you. The problem was the rulebook. Drop your level in the comments. And if someone in your life needs to hear this, send it to them. Because the trap only works if nobody tells you it's there. Subscribe. We'll keep talking.